You bought gold so you could finally stop worrying, and this stretch made you feel like the fool at the table. The metal that was supposed to be your anchor started acting like it had a ceiling bolted over the top of it. It ran, it stalled, it pulled back, and every headline seemed to lean in and whisper that you had missed the boat and bought the top. If your stomach tightened when you saw where it landed, I understand that feeling completely. I have sat across from good, careful people while that exact feeling hit them, and I have watched what they did next either protect them or cost them. So let me tell you the thing the financial channels will not say to you plainly. Yes, gold owners just ran into a wall. The move stalled, the safe haven crowd stepped back, and it felt like a door swung shut in your face. But the wall you are staring at is the wrong wall. It is a round number on a screen, and that screen was built to rattle you. The wall that actually decides the next stretch of your retirement is not a price at all. It is where gold sits against stocks in a cycle that turns slowly across whole generations. And by that measure, the wall is nowhere near where you have been told it is. Here is the one measure that has quietly told the truth for more than a century, and almost nobody on television will put it on the screen for you. Take the Dow, the big stock index everybody watches, and divide it by the price of a single ounce of gold. That gives you a plain, honest number. How many ounces of gold it takes to buy the entire Dow. Not dollars, which get watered down every year. Ounces. It strips the illusion out. And that ratio, over the long arc, does something remarkable and dependable. It swings from one wild extreme to the other, and it tells you which of the two, stocks or gold, is the crowded trade and which is the one everyone left for dead. At gold's last great peak, a generation ago, that ratio fell all the way down toward 1. Read that slowly. It took roughly a single ounce of gold to buy the whole Dow. Gold was beloved, stocks were hated, and the crowd was piled onto the metal. Then the cycle turned. Fast forward to the great tech stock mania at the turn of the millennium, and the ratio blew out to the other extreme. It took dozens of ounces of gold to buy that same Dow. Stocks were the religion. Gold was the punchline, and anyone who owned it was mocked at the neighborhood barbecue. That is the wall that matters. Not a number on your screen this stretch. The generational tug-of-war between paper and metal. Now, hold that ruler up to right now, and you see why the panic you are feeling is aimed at the wrong thing. Measured against stocks, gold is not stretched and euphoric. It is nowhere near that lonely low of 1 ounce buying the market. It has climbed off the floor, sure, but it is closer to the middle of that long field than to the far end where these cycles exhaust themselves. So when the headlines tell you gold hit a wall and the party is over, ask them the only question that counts. A wall compared to what? Compared to a round dollar figure that dazzles the eye for a week? Or compared to stocks in a cycle that has not come close to finishing its turn? Those are not the same wall, and the difference is your retirement. Let me tell you why this specific week made it feel so much worse than it is. Because the mechanism matters, and nobody explains it to you. Gold had been carrying a fear premium. When conflict looks likely somewhere in the world, and the shipping lanes look shaky, buyers pay up for the one asset that answers to no government, and that premium sits inside the price, like air inside a tire. Then the tension eases. A standoff moves toward a deal, the oil route looks like it is reopening, and that fear premium hisses right back out. The metal did not break. The insurance simply got a little cheaper because the house looked, for a moment, less likely to catch fire. That is not a top. That is a discount. I have seen this movie before, and it always plays the same way. A generation ago, when a major conflict erupted in the Gulf, gold spiked hard the day the tanks rolled in. Every trader piled into the safe haven. And then, as the world realized the thing would be contained, that spike bled away for months, even as the fighting continued. The lesson is one the financial media will never hand you because it does not sell fear on a schedule. A safe haven premium gets priced in when war looks like it is coming, and it bleeds out the moment the world exhales. If you sold your gold because a de-escalation cooled the price, you did not dodge a loss. You handed cheap insurance to the very people who understand this rhythm and were happy to take it off your hands. And here is where it gets strange, because this is the part that separates the last few years from anything I have watched in my whole career. For most of my life, gold played by one simple rule. When the return you could earn just sitting in safe government bonds went up, gold went down, because gold pays you nothing and the competition suddenly paid more. That rule was iron. You could set your watch by it. And recently, that rule broke. The return on safe bonds stayed stubbornly high, right where gold was supposed to buckle and fall, and gold climbed anyway. When a rule that reliable stops working, it is not noise. It is a signal that a new and far bigger buyer has walked into the room, and they are not looking at the same scoreboard you are. Who is that buyer? Not the traders on the financial channels, not the hedge funds chasing the hot momentum trade. It is the central banks. The same institutions that print the paper money in your wallet have been quietly buying gold at a pace we have not seen in modern history, piling it up for 3 years running at a clip that dwarfs the decade before. And it went further than that. Gold recently passed a milestone almost nobody on your television bothered to mention. It overtook the euro to become the second largest reserve asset held by central banks on Earth, sitting behind only the dollar itself. Let that sink in. The people who manage the wealth of nations are choosing bars of metal over another government's promise. If you have felt that knot in your stomach this stretch, this is the moment to stop and take a breath, because there is something you can actually do about it, and it grows straight out of what I just told you. When the largest, best-informed buyers on the planet are quietly moving a portion of their reserves into physical gold 3 years running, the honest question for you is simple. Should a slice of your own retirement do the same thing? That is exactly why my family put together the free Retirement Wealth Protection Guide. It is for everyday American retirees with $100,000 or more in a retirement account, and it walks you through in plain language how folks move a portion of the savings they already have into physical gold and silver, inside the same account, without taxes and without penalties. This is not just for insiders and institutions. If you have $100,000 or more in any retirement account, this is for you. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. From our family to yours, no obligation and nothing to buy. Now, let me bring this all the way home, because a ratio on a chart is not a person, and you are a person. I think about a retired hospital bookkeeper outside Dayton, Ohio. She spent her working life reconciling numbers that had to balance to the penny, and she carried that same discipline into her own savings. She did everything right. She saved out of every paycheck. She never chased a fad. She built a nest egg the slow and honest way. And when she finally bought a little gold to steady the whole thing, this stretch made her feel like she had blundered at the worst possible moment. She watched the number dip, and she wondered, sitting at her kitchen table, whether the careful thing had turned into the foolish thing. It had not. She was looking at the wrong wall, the same wall the headlines pointed her toward, instead of the one measure that would have told her she was still early. Because here is what that bookkeeper and you deserve to understand about how bull markets in gold actually behave. They do not go up in a straight, comfortable line. They terrify you on the way to being right. Look back at gold's greatest run, the one that ended at that peak, where an ounce nearly bought the whole Dow. In the middle of that historic climb, gold did not just dip, it nearly cut in half. Nearly in half, right in the belly of the biggest bull market it ever had. Anyone watching a round number on a screen would have sworn the run was finished and the wall was final. And then it turned and multiplied many times over into its blow-off top. The shakeout was not the end of the move. The shakeout was the toll you paid to stay in it. And that is not even the biggest piece. Watch what the trading desks do around these moments, because this is the enemy in this story, and you should know how they earn their living. When the Fed so much as hinted, once, that it might slow the flood of easy money, gold gave back better than a quarter of its value in a hurry, and nothing about the real world had actually changed. Nothing. The mines still dug, the shortage was still there, the debt was still climbing. The only thing that changed was sentiment, and sentiment is exactly what the desks manufacture. They make their money on your churn. A frightened retiree dumping metal into a dip is not a victim to them. He is a paying customer. And the silence about that, the way no one on the financial channels will ever say it out loud to you, is not an oversight. It is the whole business model. I have watched exactly this kind of wall resolve itself before, and it is worth sitting with for a moment. Not long ago, in market terms, gold ground lower for years. A long, grinding, demoralizing slide that convinced almost everyone it was a dead asset, a relic your grandfather owned. Every bounce ran into a wall and rolled back over, and then it quietly put in a bottom, and from that bottom it began a long, patient climb that carried it all the way to new records. The people who sold near that low, exhausted and convinced the story was over, were the ones who paid the toll and then watched from the sidelines as the metal did everything they had waited for. The wall felt permanent right up until the day it wasn't. That is the nature of these turns. The wall is loudest right before it gives way. And think about what actually sits underneath that long ratio, because it is not sentiment, it is arithmetic. A government that spends far more than it takes in, year after year, with no serious plan to stop, has only a handful of ways out, and every one of them quietly favors the metal over the paper. It can let inflation do the work, chipping away at what a dollar buys while the ounce sits there unbothered. It can lean on the central bank to keep the cost of all that borrowing artificially low. We have seen that exact playbook before, when the central bank pinned government borrowing costs down for the better part of a decade to make an enormous debt bearable. Every one of those exits shrinks the value of the promise in your account and leaves the metal standing. That is the engine under the ratio. It is not magic and it is not a meme. It is the slow, grinding math of too much debt meeting too little discipline. Let me be honest with you the way I would want someone to be honest with me, because you should never trust a guide who only shows you the upside. I cannot tell you where gold trades next month, and I am not going to insult you by pretending I can. If the Fed stays divided and the hawks who want to keep fighting inflation win the argument, higher for longer returns on cash can lean on gold for a while, and this stretch could stay choppy and frustrating. A de-escalation can hold, and the fear premium can stay drained out for months. This is a case, not a promise, and there is no guaranteed price at the end of it. What I am telling you is not that gold cannot fall. It is that the reason to own a portion of it was never the next few weeks. It was the long ratio, the generational cycle, and the fact that the smartest institutions on Earth are voting with their vaults. And here is the part almost nobody connects, so watch this. Why can a central bank not just hold another country's bonds and call it a day? Because of a lesson the whole world learned the hard way a few years ago, when one major power had its reserves frozen at the stroke of a pen after a conflict began. In an instant, a mountain of another government's promises became unusable, frozen, political. But gold sitting in your own vault cannot be frozen by anyone. It answers to no committee, no sanction, no foreign capital. That is why the buying accelerated after that freeze. And that is the exact same logic, scaled down to your kitchen table, behind owning a portion of your wealth in metal you actually hold rather than a promise you merely count. Now I want to answer the title's question head on, because you click for a straight answer and you have earned it. Did gold owners hit a wall? On the screen, in the short run, yes, and I will not pretend otherwise. But the wall that decides your retirement is the one the headlines never show you, the ratio of gold against stocks in a cycle that turns over decades. And against that wall, gold is not late. It is closer to the beginning of its turn than to the end. The people telling you the party is over are pointing at a round number and hoping you never look at the real ruler. Now you have looked at it. Think about how these turns actually reveal themselves, because this is the piece the patient viewer gets and the crowd misses. The central banks are already positioned. They did their buying quietly, in the years when gold was ignored and mocked, when it made no headlines at all. The pension funds, the big advisors, the financial media, they are not there yet. They will arrive, but they will arrive loud and late, after the metal has done most of its work, when it finally leads the evening news and every advisor suddenly recommends it at the neighborhood barbecue. By the time it is that obvious, the easy part of the road is already behind you. The whole advantage is in understanding the ratio and acting on it while it still feels a little uncomfortable, while the crowd is still staring at the wrong wall. That discomfort you feel right now is not a warning. It is the admission price. So let me give you the honest, practical way to think about your own position. And it is not a prescription, it is a principle. Own an amount you can actually sit with through a shakeout, because the whole game is not being forced to sell at the bottom. The retirees who get destroyed are not the ones who own gold. They are the ones who owned too much of it on borrowed conviction and got shaken out at the worst possible moment, right before the turn. Size It's So a scary week can never force your hand. Own the real thing, the metal itself, not a paper claim that can evaporate when you need it most. And never, ever hand your discipline to a trading desk that profits from your fear. That bookkeeper in Ohio did not need to sell. She needed to understand the ruler she was measuring with. The moment she did, the knot in her stomach loosened, because she finally saw that she was early, not late. And that brings us to the most important thing I can leave you with, because this was never only about you. It is about what you pass on. The wealth you spend a lifetime building is not just numbers in an account. It is the head start you hand your children, the security you leave your grandchildren, the proof that a careful life meant something. That is why the second reason I made the free Retirement Wealth Protection Guide is the legacy in it. Protecting and diversifying a portion of what you built so it survives not just the next scare, but the next generation. And for those of you with 100,000 or more who watch all the way to the end here, I want to offer something more personal. Mention that you watched this full video, and you can sit down with my family for a free, one-on-one educational web conference. Just a real conversation about your own situation, no obligation, and nothing to buy. Why now? Honestly, with no fake clock and no phony deadline. Because the window where this decision is still cheap and calm and completely reversible is exactly the window when nothing feels urgent, when the crowd is looking at the wrong wall and calling you foolish for even asking the question. That window is open right now. Once the ratio has done its work and it is obvious to everyone, the easy, unhurried part of this is over. If you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. From our family to yours. So look one more time at that bookkeeper in Ohio, sitting at her kitchen table, wondering if the careful thing had become the foolish thing. It had not. She was never looking at a wall. She was looking at a discount, dressed up as a wall, by people who profit when you flinch. The screen will keep trying to scare you with round numbers. Let it. You have the real ruler now, the one that swings across generations, and it is telling you the same thing it told the central banks before anyone was watching. This is not the top. It is the part before the crowd shows up. Do not let a wrong wall talk you out of the right decision.